In this video, we're going to look at how Fitch derives the long-term issuer default rating, or IDR, for non-bank financial institutions, or NBFIs, by applying the higher-of approach between the issuer's Standalone Credit Profile, or SCP, and its support-driven rating. Please refer to the video Assigning Issue Ratings to Non-Bank Financial Institutions for an outline on how we assign ratings to different classes of debt obligations issued by NBFIs. The SCP reflects an NBFI's intrinsic credit strength, excluding any potential extraordinary external support. In other words, where extraordinary support is not relevant, the assessed SCP is the sole driver for the IDR. Fitch follows 3 steps to determine the SCP. The first is to derive the Sector Risk Operating Environment, or SROE score. This incorporates both a jurisdiction-based operating environment, or OE score, and a sector risk assessment, or SRA, upper boundary. We then derive the scores for the 7 other key rating drivers, or KRDs: business profile, management and strategy, risk profile, and 4 financial profile key rating drivers. Finally, we combine these scores to derive the implied SCP. For each of the steps, category-based implied score is first derived, which can then be adjusted up or down using analytical judgment to arrive at the notch-specific assigned score. Adjustments are applied where there are factors that are relevant to Fitch's analysis, but not fully captured in the core metrics that determine the implied score, or there may be cyclical or structural features that, in Fitch's opinion, mean that historical ratios may not be reliable predictors of the future. The possible reasons for adjusting the key rating drivers are listed in the criteria and will be disclosed in Fitch's research where the assigned score is a category or more above or below the implied category score. Lastly, the final SCP may be adjusted up or down from the implied SCP where there is a sector risk sovereign rating constraint, there is a unique business profile, management and strategy or risk profile consideration, or when one or more financial key rating drivers represent a weakest link. Fitch applies fixed weightings to the key rating drivers scores to derive an implied SCP, which can then be adjusted up or down to get the final SCP. Recognizing the different business models across the various NBFI sectors, Fitch applies 2 sets of weightings, as shown in the table, to accommodate the different degrees of balance sheet usage. Each key rating driver factor is scored on the AAA scale and then weighted to determine an implied SCP, also on the AAA scale. The SROE influences the SCP through its impact on our assessments of the other key rating drivers. However, we do not assign the SROE an independent weighting to avoid double counting. If an issuer undertakes both high and low balance sheet usage activities, the applied weightings will be determined by which business activity has the greater influence on the issuer's overall risk profile. Fitch considers 2 aspects to arrive at an implied SROE category score. The first is a Sector Risk Assessment Category Score, or SRA upper boundary, that is applied to reflect business model-specific attributes at a sector or industry level. This is depicted by the gray box. The second is a jurisdiction-level operating environment category score, which is depicted by the light blue box under Sector Risk Operating Environment. The implied SROE category score is equal to the lower of the 2, as shown by the orange line. The assigned SROE score typically acts as a constraint on the SCP given the strong influence of the operating environment on other aspects of an issuer's credit profile. As a result, the SROE score will often constrain the business profile score, and the business profile will typically not be scored above the SRA, as shown by the green line. In addition, the implied and assigned key rating driver scores are limited to 1 category above the assigned SROE score, as shown by the red line. The implied key rating driver scores are derived by applying the benchmarks for the business profile and financial profile key rating drivers outlined in the criteria. The management and strategy and risk profile key rating drivers are not derived from quantitative benchmarks, but rather analytical judgment based on relative and absolute assessments. Quantitative benchmarks for high balance sheet usage NBFIs are typically tiered by SROE to reflect greater sensitivity of their business models and financial metrics to operating environment dynamics. Benchmarks are not tiered for low balance sheet usage business models or for sectors where operating environment differences are not present, such as business development companies or BDCs, which operate in a single operating environment. The SRA upper boundaries listed in this table represent the typical rating profile of leading NBFIs within the sector. SRAs that have not been established for certain business models, such as investment companies, where the range of potential activities or regulatory frameworks within the subsector leads to broad sector risk considerations. Where this occurs, the implied SROE category score is derived from the jurisdiction-level operating environment category score and then adjusted up or down to derive the assigned SROE score. A similar approach is applied for entities with activities that are more closely aligned to bank business models. Where support is a relevant analytical consideration, Fitch assigns either shareholder support ratings, or SSR, or government support ratings, or GSRs, where there is a likelihood that in case of failure, an NBFI will receive extraordinary support from its shareholder or government sources, respectively, to prevent it defaulting on its senior obligations. Either an SSR or GSR would be assigned depending on which of both sources is more likely. To determine a support rating, Fitch considers the ability and propensity of the provider to extend support. Our starting point is typically the long-term IDR of the source of support, be it from a shareholder or the government. We then consider the key rating drivers listed in this slide depending on whether a shareholder or a government support rating is assigned. Where support is a relevant consideration, Fitch typically aligns the support-driven rating with the support provider's rating or notches downward from the support provider's rating. In limited cases, however, Fitch may notch up for support from an issuer's SCP. Notching up for support is considered where a top-down approach is not applicable, but a modest degree of support likelihood exists and the source of support is stronger than the SCP. The IDR incorporating bottom-up support is typically limited to the rating level implied by the most conservative top-down assessment, i.e., 3 notches.